Guys, Outhenticfx here. Today's course will be on order blocks, specifically bullish and bearish order blocks. I will be explaining how we trade off them and how we use order blocks to our advantage, guys. So now let's get into it and start here on the left side. An order block is the final candle before an impulsive move that leads to a break of structure. This basically means that the most recent higher high or lower low is taken out, guys. So you will obviously see price channeling whether bearish or bullish, creating lower lows, lower highs, and then creating that break of structure, leading to our bearish order block, and then creating higher highs and higher lows, breaking structure to the left and forming that bullish order block, guys, depending on the direction, of course. If a higher high or lower low is not taken out, and price proceeds towards the upside or downside, then that final candle is not considered a valid order block. Price must break structure to be valid, right? So if for example, if price reacted to this area of supply and then pushes down, but does not break structure to the left, but creates equal lows, which we're going to mark off here, that means that this order block is not yet valid till we get the break of structure. If price does not break structure and starts consolidating with this area, we need to wait for the supply zone to be formed, which will break structure at that point, guys. So at this point, we need to see the break of structure to confirm that order block. BOS button. Okay, cool. When we take a look at supply and demand or bullish and bearish order blocks, the concept is actually quite alike, guys. What I'm trying to say is that the untested supply and demand zones that we look for, which I explained in the supply and demand zone video, are untested order blocks. It's basically refined. So these order blocks are more detailed, or it's a more detailed rule-based strategy, right? And then from there, they are most likely to have the same reaction within our point of interest. A quick rule of thumb: the 50% equilibrium point of a particular order block can act as a strong level where price likes to mitigate to before continuing in an overall direction. If price comes up to fill the 50% or even the 100% of the order block, then we can now classify that order block as mitigated and completed and invalid for future interest, right? So if you see here, guys, this is a supply zone. We have our last bullish candle before the expansion to the downside. Price then comes from the downside, returning into that area. If price taps in only at this level, that means the 50%, which is the halfway point of this entire candle, has not been fully mitigated. So in future, it will come back to fill the 50% or even the 100% before creating the large expansion to the downside. Vice versa with the bullish order block, right? It's the last bearish candle before the major move down. If price comes back into that order block and does not fill the 50% of that candle, that basically means that price will eventually come mitigated fully and then push up, guys. So we always need to consider that and see how price is being delivered into that specific area. The time frame you're trading and the market structure you are currently seeing is very important. Meaning, are you seeing bullish market structure? If you are, then it will make sense to be looking for long positions at demand zones, bullish order blocks, right? Rather than looking at supply zones, guys, and shorting bearish order blocks. This concept applies to bearish structure, right? So if price is bullish, why are you looking for shorts, right? Move with the trend, guys. The trend is your friend at the end of the day. You are most likely to be profitable following the trend than trading against it. It's similar to what I said, trading against the banks never works out. This concept also applies to bearish structure, guys. If price is bearish, do not try looking for long positions in a bearish market. You're most likely going to get a few pips and then get clapped. So usually the higher time frame order blocks are more have a higher probability, at those zones or order blocks, right? The higher time frame order blocks are more, reliable when it comes to trading, from your H4, your daily, and your 1 hour, compared to the smaller time frames, because there's just multiple candles and, you know, different situations going on, different patterns that are getting played out at that point. So it's harder to spot the perfect order block on the higher time frame. On the lower time frame, sorry. So to get into the detailed outlook of order blocks, we're going to be looking at bullish and bearish order blocks, right? So we're going to start off with bearish order blocks, right? A bearish order block is the last candle before the bearish expansion / impulse move that breaks structure to the downside. So you see the last bullish candle before that expansion breaking structure to the left, right? You will see a large momentum to the downside, right, which usually leaves behind some price imbalance. So within this move, we'll see large body candles and no wicks, guys. I will show you a live example on the charts now in a few of that, and this will show you that, okay, cool, price is breaking structure and momentum is to the downside. Central banks have placed big orders at these areas in the market, hence why we'll see large body candles going down. This is the theory, guys, right? When it comes to bearish order blocks, it is eventually going to gravitate back towards this area, and then from there to rebalance price, fill any liquidity, and then from there continue in its direction. Once we get these order blocks formed, they normally leave behind imbalance, so price needs to return back and have price efficient before continuing down. So look here, so now we've got price breaking structure. Obviously, let's use that for example. This created a lower low, right? The market is bearish, there is imbalance in this area. Price needs to come back, fill this imbalance, and then be activated in this order block, and then continue, leaving behind another order block which we'll look for in future. But this order block has been fully mitigated as price has came all the way up and returned. Instead of returning only halfway, it came all fully up, guys. So to get into bullish order blocks, a bullish order block is the last down candle before the bullish expansion / impulse move that breaks structure to the upside, right? So you can see we came into this area, we pushed up, we broke structure to the left. Once structure was broken, we returned back into this bullish order block and then broke structure for the second time, leaving behind a second untested order block, right? So this is when you will see large momentum to the upside, which will usually leave behind some price imbalance, right? I will show you an example in the live chart in a few. Order blocks are just fancy ways of saying supply and demand levels, guys. Central banks have placed big orders at these areas in the market, and the theory is when it comes to bullish order blocks that price will eventually gravitate back towards these order blocks to rebalance price, fill any liquidity, and move the same direction which it intended to move in the first place, guys, right? Once we get these order blocks formed, they normally leave behind imbalance, so price needs to return back and make price efficient before continuing up. So now let us get into the live markets and charts and see what these bullish and bearish order blocks are and how they react to the market. Okay, here we have an example of a supply zone / bearish order block. So I'm going to write that down, supply zone, and then put in bearish order block, right? Bearish order block, we have that right there. And then from there on our right side, we have a demand zone, bullish order block. Perfect. Okay, cool. Let's get into it. So as I said, guys, the supply zone / bearish order block is the last bullish candle before the major expansion to the downside. So you can clearly see that price has been pushing up in this area, consolidating, moving sideways. And then once we created this range, which is a bearish consolidation block or supply zone, we leave behind this bullish candle here. This bullish candle is our order block. It was our last up candle before the major move down. Look at the way these candles start forming big bodied candles. We started off here, small bodied candles leaving behind a lot of wicks, and then all of a sudden these candles just suddenly started melting. This area of, you know, clean candles just moving down is called imbalance. So what the banks will do is they will rebalance price by bringing price back up to that original expansion, which broke structure to the left, activating either 50% or 100% of that order block, meaning filling it, and then continuing in the overall direction, guys. So here you can see price came back in, we get in for a sell, we follow the banks, guys, we go with the trend, price is bearish, so there's no need for us to be looking for buys at that current point, right? Now notice, guys, look at the left side here, we break structure to the left again, right? Break of structure, BOS bottom, right? What does price then need to do? Price then needs to now come back into this area of this order block, which I'm going to mark off here. And I'm going to mark it off as red so that we can see it clearly. It needs to rebalance all this imbalance here, which it does finally come back into. And then that's our sell position over there. We can get in for another sell at this area because price has mitigated that order block fully, and trade that sell into our demand zone, guys. Into our demand zone, right? Oopsie. Into our demand zone. Push that down, take that there. Perfect. Okay, cool. Into our demand zone, guys, right? So as I said before in the previous lesson, supply and demand works like a magnet, guys. They're attracted to each other. From supply goes to demand, from demand goes to supply. So look here, let's delete this so you guys don't get confused. Right, demand zone, which is a bullish order block, right, is our last down candle or bearish candle before the major move up. Notice now we have a clean break of structure to the left. Price breaks structure aggressively, leaving behind big body candles. So all the gaps between these candles, that's imbalance, guys. The banks need to fill that. What will happen is the banks will rebalance price, and then that's where we enter in for long positions, guys, and target the next high, right? Obviously, you can see in this instance, we caught 72 pips with a stop loss of about 13 pips, guys. So very clean setup. Here we caught 93 pips, you know, with a 8 pip stop loss, guys. So supply and demand is very important when it comes to trading. Very simple concept to use. It helps us trade with the banks instead of trading within these small areas and getting faked out with all those wicks, guys. We're looking for the big pushes to the upside, guys. The aim is to always trade with the banks, guys. The banks are your friend, guys. So as I said, to recap everything that I said, supply and demand are basically bullish and bearish order blocks, just refined. I am going to get into detail on how to refine an order block in the next video, but for this video, an order block, remember, in a supply zone is the last bullish candle before the major move down, breaking structure to the left. If price does not break structure, that order block is invalid, guys. And then from there, a demand zone, which we are going to start calling a bullish order block, is the last bearish candle before the major move up, guys. So which breaks structure to the left. Remember, we always need to break structure, guys, moving up. All right. So when it comes to refining your order blocks, I will get into detail on that on the next video. But for now, guys, I think that's all. That is the best example that I can show you for now on the live markets. Let's get into it and then see you guys in the next video. Ciao.